Okay, welcome back to Accounting 101. In this video, we will be going over the solution to problem 3-35A, or as they refer to it, P-F:35-3-35A. I believe last tape I may have done the adjusting journal entries. So for the sake of continuity, so you don't have to flip back and forth between videos, I'm going to start from the beginning. So you're going to have a little bit of repetition here. Ugh. Yeah, mouth isn't working. All right, so they start off with giving us the unadjusted trial balance for Aniston air purification system. And I'm going to give you, I have stuff written down, but I have the journal entries in an Excel spreadsheet, and I have a worksheet that will cover part 3. Part 2, I have papers here for the T accounts for the general ledger postings. So they give us the unadjusted trial balance there for December 31, 2024. And we can see that the debits and credits are equal. And then they give us adjustment data as of at December 31 as follows. Adjustment A, on December 15th, Aniston contracted to perform services for a client receiving $3,100 in advance. Aniston recorded this receipt of cash as unearned revenue, so they would have debited cash and credited unearned revenue. And then it tells us as of December 31, Aniston has completed $2,100 of the services. So that would have been entry number 1. Not number 1, entry letter A. So we would reduce the liability unearned revenues by $2,100 and transfer it to a revenue account, service revenue credit, $2,100. Adjustment data B, Aniston prepaid 2 months of rent on December 1. Assume the prepaid rent balance as shown on the unadjusted trial balance represents the 2 months of rent prepaid on December 1. If you go up to the adjusted trial balance, or the unadjusted trial balance, you'll see that there's $2,900 in that account. I have it here. I'm going to send you a copy of this. Where's the prepaid rent? Prepaid rent, $2,900 debit balance. So that's for the month of December and the month of January. At the end of December, half of that, it's for 2 months. So 1 month out of 2 months has been used up. So take half of that amount, or divide the total amount by 2 months and get the monthly fee. So it would be a reduction to the asset prepaid rent of $1,450 and transferring it to rent expense, a debit of $1,450. C, Aniston used $750 worth of office supplies. Well, here they're telling us how much was used up, so that's the amount of the expense. Be careful when you have a situation with office supplies. Sometimes they will tell you the balance of the account and how much is on hand, and then you have to take the difference to figure out how much was used. Here they were nice about it, but it can be confusing. They used $750 worth of office supplies, so the asset office supplies is going to be credited for $750 to reduce the asset, and it goes to supplies expense, $750 debit. D, depreciation for equipment is $850. So we have depreciation expense, equipment, $850. Accumulated depreciation, equipment, $850. Transaction E, Aniston received a bill for December's online advertising, $1,100. Aniston will not pay the bill until January. Use accounts payable. So we have an accrued expense. The expense has been incurred. We had the ad run in the paper or on radio or TV, wherever. And they send us a bill for it. We're going to pay for it in January. So we have to record the expense. Item E, advertising expense is going to get increased with the debit of $1,100. Accounts payable, the liability is going to get increase with a credit of $1,100. All right. F, Anderson pays its employees on Monday for a previous week's wages. Its employees earn $5,250 for a 5-day work week. December 31 falls on a Tuesday this year. So the first thing we have to do is take that 5-day pay of $5,052.50 divided by 5 days. The daily amount of payroll expense is $1,050. It's for 2 days, Monday, December 30th, and Tuesday, December 31st. So 2 times $1,050 would be $2,100. So we increase the salaries expense for $21 and credit the liability salaries payable for $21. The expense was incurred because the employees worked Monday and Tuesday, December 30th and 31st. They're going to get paid on Friday, January 3rd, but that's in the next accounting period, the next year. Finally, item G, on October 1, Aniston agreed to provide a 4-month air system check beginning October 1 for a customer for $3,400. Aniston has completed the system check every month, but payment has not yet been received and no entries have been made. So we have a deferred an accrued revenue here, right? We've done the work for October, November, December. It's a 4-month contract. We didn't do any recording yet. We didn't get paid. We didn't bill the customer. But we're still entitled to recognize the revenue because we have completed the work for October, November, December. We have to still give them a system check in January. So we can take that $3,400 divided by 4 months, the duration of the contract. Oops. I believe it's $850. Yes, $850 a month. How many months have gone by from October 1 through December 31? October, November, December. So 3 times the $850 is $2,550. So we have to book the revenue. So the revenue gets increased service revenue, $2,550. We didn't pay them, or they didn't pay us. We didn't bill them yet, but we're going to set it up as a receivable. And hopefully we'll send them, when we're done, we'll send them a bill in January and get paid in February. So those are the entries. Again, I have them nice and typed up. I'll send that out to you along with the same email that this tape will be coming to you in. And now we have to do the posting of those entries. So it says, take the accounts listed in the unadjusted trial balance, open T accounts with the unadjusted balances, and then post the adjusting entries to the T accounts. So I got my handy dandy T account sheet here. I went through that unadjusted trial balance, wrote down all the accounts and the balances, whether they were debit or credit, and set them up like so. So now I'm going to post them. And what I think I'll do is I'll post them in Reading so you can see the journal entries, and I'll reference them by a letter. So what I'll do, I'll go right in order: A, B, C, D, E, F, G. So A, there's a reduction to the liability unearned revenue. So find unearned revenue right here. It's got a balance of $3,100. We're reducing it. The adjusting entry debits that account for $2,100, the amount of work performed. Okay. And then I will credit service revenue for $2,100. So I reduced the liability, and I picked up the revenue for $2,100. B is for the rent that has expired from paid rent. So rent expense gets a debit of $14.50. Down here. And the asset prepaid rent gets a credit for $14.50. C, office supplies were used to the amount of $750. So office supplies are going to be credited $750 for item C. With an offsetting debit going to supplies expense. It's on the other page. Supplies expense is getting a $750 credit. Right there. Item D, depreciation expense. On the equipment, $850 debit to the expense account. And accumulated depreciation, which will be up by, here's the asset account. Here's the accumulated depreciation that modifies it. Oh, I put the $2,100 on unearned revenue in the wrong place. I'll scratch it out. And I'll put it in the right place. So I just scratched it out and put the unearned revenue, reducing the liability for the amount we've earned. And now the accumulated depreciation will get its credit of $850. Down here, we had the expense getting debited. Accumulated depreciation is an offset to the asset, so the normal balance would be opposite of the asset is a debit normal balance. The accumulated depreciation has a normal credit balance. So to increase it, we would credit it for $850. The advertising expense is increased by $1,100 in adjusting item E. Right there. And accounts payable gets the offsetting credit. Item F, the accrued expense for the salaries. So salaries expense is getting a $2,100 debit. And oops, there we go. Sorry about that. And salaries payable is going to pick up a credit of $2,100. Salaries payable right there. Salaries payable. Okay. G. The accrued revenue. So accounts receivable is getting $2,550 debit. And service revenue is getting a credit of $2,550. So you can see service revenue had two adjusting entries affected on the credit side. All right, so now we have to go through our T accounts in our general ledger and compute new balances for them, and then just write down all those accounts and do the trial balance. So cash has not changed. Let me get my handy dandy little calculator out here. Accounts receivable had a $19,700 balance, and it had a $2,550 increase with the credit. So now we have $22,250 debit balance in accounts receivable. Prepaid rent had $2,900. $14.50 was used up, leaving a balance of $14.50. You can see cash wasn't affected. Accounts receivable was affected. Prepaid rent was affected by the respective adjusting entries. Office supplies, $1,800 was the balance. $750 were used. So we got a credit, leaving us a balance of $1,050 in office supplies. Equipment is what it is. Accumulated depreciation, we had a $3,900 credit balance and a $850 credit for the adjustment. $3,900 gives us a new balance on the credit side of $4,750. What's next? Accounts payable went from up to $4,000 because it was adjusted for item E. Yeah. Salaries payable, just the one item. Unearned revenue had a balance of $3,100. Was adjusted to reflect the fact that we earned $2,100, so we only have a outstanding liability for unearned revenue of $1,000. Common stock is the same. Dividends are not affected. Service revenue had two items affecting it. Two adjustments to had a balance of $15,300. So we're going to add $2,100 for the first adjusting entry A, and then the last one G increased the credit $2,550. So our new balance in service revenue is $19,950. There's the beginning of the balance that was in the account. Adjustment A, adjustment G, new balance. They're credits, so you add them. Everything's on the credit side, you add them. Salaries expense had a balance of $3,300. Adjustment was for $2,100. It would make it $5,400. There was the expense. Increased the expense for the accrued payroll. New balance $5,400. Rent expense, only one entry. Same thing with the depreciation expense, only one entry, so just double line, so we know that it's a balance. And then finally, we have our advertising expense, had an $1,800 balance. We made an adjustment of $1,100 to bring that up to $2,900. And the supplies expense. Okay. Oops, there we go. All right, so now it says do a adjusted trial balance, which is in your Excel spreadsheet I'll be sending you. Here's what was in the book, the unadjusted trial balance. Here are the adjustments with the reference to the adjusting entry by letter. Okay, and then all you do is if it's a debit, if it's a debit and a debit, you combine them and bring it over. If it's a credit and a credit, you combine them and bring them over. If it's a debit and a credit, they offset, bring the balance over, whichever is a higher balance, debit or credit, that's what column you put it in, and so on and so forth. Okay, so if the adjustment is the same as what the balance is on the unadjusted trial balance, you add them. If it's a different, then you subtract them. Okay, so let's see. I'll hold this up. And again, you can look at them once I send you the attachments. Let's see. I'm going to read off from the, I'm going to take the T accounts from the general ledger and see that I got them right here. Let me fold this over so we don't get distracted by the rest of the worksheet. You can't see the accounts, but they're in order. So cash is $7,600 debit. Accounts receivable $22,250 debit. Prepaid rent is $1,450 debit. Office supplies is $1,050 debit. Equipment is $22,000 debit. Accumulated depreciation equipment, $4,750 debit. I'm just going to check here. 7,600, 22,250, 1450, 1,000. Liabilities, accounts payable, the credit balance of 4,000. Salaries payable, 2,100 credit balance. Unearned revenue, $1,000. 4,000, 2,100, and 1,000. Common stock, 43,800. Credit balance, dividends, 9,900. Credit debit balance, service revenue, 19,950. And then all our expenses. Salaries expense, 5,400. 1,450 for rent expense. Depreciation expense, 850. And then advertising expense, 2,900. And 750 for office supplies expense, or just supplies expense. So now all we have to do is take the worksheet information and put it in a nice format as a formal trial balance. So I'll put the heading up on top here. Aniston air purification system. Adjusted trial balance. December 31, 2024. There's the heading. Name of the company, name of the statement, adjusted trial balance, and the date. Account name, debit credit columns. I'll put those up there. And I'm just going to go through in order, listing of T accounts and their balances. Cash, 7,600. Accounts receivable, $22,250. Prepaid rent, $1,450. All assets so far, so they should have a normal balance of a debit, and they have. Office supplies, $1,050. Equipment, $22,000. Maybe a spot check right there. All 5 asset accounts, debit balance. Now we have the accumulated depreciation on the equipment. It's going to have a credit balance. $4,750. First entry in this credit column, so I'll put a dollar sign on it. First entry in the debit column for the cash account gets a dollar sign. Nothing else gets a dollar sign until we come to a line in that column. Okay, so now we have the liabilities. Accounts payable should have a credit balance being a liability, and it does, $4,000. Salaries payable, $2,100 from the adjustment entry. Unearned revenue. We earned some of it, so it's a little bit lower than what it was. But it's still a credit balance, still a liability, $1,000. So there's the liabilities in the credit column. Now we get to the equity accounts. Common stock. Credit balance of $43,800. Dividends, contra equity. So it's a debit balance, $9,900. Service revenue, revenue account. We go back to the credit column. $19,950. And there's the common stock right here. There's the dividends. Then back to the credit column for the service revenue. Now we'll list our expense accounts. Salaries expense, $5,400. Debit balance. Rent expense, $1,450. Debit balance. Depreciation expense, on the equipment, $850. Let me make a notation here. The depreciation expense is only for the 2024 year, the depreciation on the equipment. The accumulated depreciation account up here for the equipment is all the years that we've had the equipment, 2024 and the previous years. Okay, so that balance offsets the equipment account, the asset equipment, those two things together. The expense is only for this year. The accumulated is for all years that we've had that piece of equipment. Advertising expense. $2,900 debit balance, and supplies expense. $750 debit balance. Now, I had it in the Excel spreadsheet. I used the AutoSum thing, and I have the numbers, but I'm going to add them up again, just to make sure I didn't make a mistake. And hopefully I didn't. If I do, I'll be embarrassed. 7,600 plus 22,250 plus 1,450 plus 1,050 plus 22,000 plus 9,900 plus 5,400 plus 1,450 plus 850 plus 2,900 plus 750. 75,600. Where's my worksheet? $75,600. Credits, not as many to add up. So 4,750 plus 4,000 plus 2,100. Plus 1,000, plus 43,800 for the stock, and 19,950 for the service revenue, and 75,600. So the debits and the credits equal. And that's the trial balance. All right, so sorry to have to split it. Maybe it's better that we split it. You can sometimes overdose on this stuff. So that's problem PF3-35A.